Google is so dominant in the world of AI search engines that its name has become a verb. But as ChatGPT and other AI tools become more popular, some on Wall Street are wondering if the company's search empire is about to crack. Can Google defend its terrain by doubling down on its own AI services, or has it already lost its cool factor with the next generation? To start, let's look at this chart from analyst Emilius Research. It shows Google's recent growth in paid clicks to sponsored Google search results. As you can see, growth slowed to 2% in the latest quarter, which was the lowest growth rate on that metric in at least 5 years. The concern is that Google is being forced to adjust its business as more people turn to AI services for help, instead of traditional search engines. Now people go to services like ChatGPT for help with homework, social situations, and repairs around the house. In response, Google has started showing its own Gemini AI results above the traditional links to other websites that appear after a search. Sponsored links have been Google's big moneymaker, but now they sit farther down the page. Google, for its part, says AI hasn't been bad for business. The company said it's monetizing its AI search results at a similar rate to what it's been seeing with paid search queries. And overall, it's been able to charge more for clicks to paid search results. The cost per click was up 7% in the latest quarter. But that's part of the problem, according to the analyst Emilius Research. They think that pricing moves are propping up Google's ad business, but they worry the company won't be able to sustain those pricing benefits as the AI scene gets more competitive, or if the economy worsens. ChatGPT is hugely popular with younger users, but OpenAI hasn't introduced ads on that service yet. If the company does, it could hurt Google's ability to charge up for its own search results. And search-related areas are responsible for more than half of Alphabet's revenue, so a lot is at stake for investors. Alphabet stock has come under pressure so far this year, falling over the course of 2025. And in the process, the stock has become quite cheap. An analyst at Bernstein noted in mid-April that Alphabet's price-to-earnings multiple was not much higher than eBay's. Since eBay isn't exactly seen as a cutting-edge business these days, that gives you a sense of the doubts around Google. For investors, it's worth keeping an eye on Google's paid click rate and whether the company is able to reignite that growth in future quarters. Investors should also watch for signs of a slowdown on that cost per click rate, which right now is the main driver of search revenue. Beyond that, the Emilius analysts say it's worth remembering that hot companies don't always stay golden forever. They recently gave the example of Kodak, once a powerhouse in photography. The company lost its way in the age of digital cameras and smartphones. Google has a lot more money at its disposal than Kodak ever did, but Wall Street will be looking to see if it can put that cash to work smartly and retain its edge.